Good afternoon, everybody, and welcome. My name is Grant Williams. I'm a Portfolio and Strategy Advisor at Vulpes Investment Management in Singapore, and for the past several years, the author of a weekly investment letter called Things That Make You Go, Now, today I want to strip things back and talk a little bit about a subject that's at the core of my own personal investment process, but it's something I think often gets overlooked in this world of information overload we live in. Simplicity. Now, in the words of Leonardo da Vinci, simplicity is the ultimate sophistication, and today, with the increasing involvement of technology and the massive information available at the click of a mouse to anybody, it's becoming much harder to find that basic simplicity that lies beneath every single decision we make as investors. The very use of the word investing implies a thorough decision-making process, sound analysis, and a certain amount of time and patience on the part of an investor once an idea is generated. Investing is fundamentally different to both trading and speculating, each of which implies a shorter time frame and a far bigger degree of uncertainty surrounding the longer-term prospects of a particular idea. When we trade, we commit capital to an idea. When we invest, we commit not only capital, but time. As you can see from this chart, the average amount of time committed to holding a stock has been falling consistently since the mid-1950s, so much so that in 2009 the average holding period reached a low of 8 months. Now, since 2009, with the increase in high-frequency trading, which now accounts for roughly 40% of the daily turnover on the New York Stock Exchange, we've reached the stage where we measure holding periods in certain stocks in seconds. But have these advances in technology, this increased sophistication, actually improved the quality of investments? Here's a chart that I'm sure everybody's familiar with. It's the S&P 500. Now, contrary to popular belief, when you invest, you make your money when you buy something, not when you sell it. And if you look at the S&P 500 going back to the start of the great equity bull market of the 80s and 90s, it's a perfect illustration of that. If you'd invested in the S&P on January the 1st, 1980 and decided never to trade again, your returns would have been spectacular over pretty much every extended period you cared to measure. Over 5 years, you were up 66%. Over 10 years, 227%. 15 years, you're up over 350%. 20 years took you to the top of the bull market and you were up 1,261%. 25 years, still up 1,000% despite witnessing the crash after the NASDAQ bubble burst. And 30 years, well, by holding your shares through 2008's collapse, when a lot of people panicked and sold, because of the timing of your original investment, you were still up 933%. So despite your overall gains falling a little as the bull market transitioned from a steady appreciation into the kind of volatile patterns we generally witness at inflection points in all markets, they remain substantial, far higher in fact than they would have been had they been sold at the height of the panic in September 2008, or for that matter any of the other corrections along the way. Now in a second I'm going to show you a chart I saw some years ago, and it had a profound effect on me. It was in an article by a guy called Bud Conrad of Casey Research, and for those of you who aren't familiar with Bud's work, I urge you to seek him out. He's absolutely fantastic. The chart demonstrates the real simplicity in investing, how with just 4 single trades over a 40-year period, it was possible to make astronomical returns by simply identifying a secular trend, buying into it early, and staying with it. The simplicity in investing comes when we don't try and beat the market or pick a top or a bottom and try and make an extra 5 or 10%, but when we identify an asset that, based on thorough analysis, is undervalued by the majority of people, and we hold that until either the facts surrounding it change or the majority comes to the same realization we did. The difficulty comes in holding on. We're going to go back to 1970 now, January 1970 to be precise. The Beatles are still together. Pan Am has just started flying 747s direct from JFK to Heathrow. But more importantly to us, US 10-year Treasury bonds were yielding 7.8%, if you can believe that. The S&P 500 was trading at 92, and the Japanese yen was still fixed at 360 to the dollar. As you can see, it was a different world. It was a different world for gold too. In January of 1970, an ounce of gold cost $35.17. Now, 1970 marked the start of a 10-year bull market in gold that would take it to what were then unimaginable heights, but not in a straight line. If you'd bought 1 ounce of gold in January 1970 and held it for the entire decade, that $35.17 you paid for it had turned into $512. That's 14 times your original investment, which is not a bad return for just sitting on a good idea. On the last day of 1979, if you'd switched that $512 from gold into what now looked like a more compelling investment, Japanese equities, that $512 would have bought 18 3/4 shares of the Nikkei in dollar terms, which back then was trading at 6,500. 10 years later, on December 31st, 1989, coincidentally enough, the Nikkei hit its all-time high of 38,915. And for anyone paying attention, it was clearly time to get out of Japan. Now, I'm going to look at each of these decade-long trades up close in a minute, so just bear with me. I know this looks easy, but we'll get into it in more detail in a second. The good news was the $512 we put into Japan was now worth $5,074, another tenfold increase. The next trade was the NASDAQ. On December 31st, 1989, that $5,000 would have bought us just over 11 shares of the NASDAQ, which at that point was trading at 454. And if you thought the previous 2 decades were fun, boy, were you in for a ride. By the time the 90s came to a close, with a spectacular blow-off top in technology shares, that $5,000 had grown 900% to $45,413. By now, though, NASDAQ valuations were clearly way too high. It was time to find another simple, long-term idea. By now, that single ounce of gold we'd sold at $512 in 1979 had come all the way back to $281 an ounce. And the case for owning gold again was very, very strong. What's more, we could now buy 161 ounces with the money we'd made after selling the 1 ounce 20 years previously. To make things easier, let's assume we held that gold for 11 years this time and sold it on December 31st of last year. We would have realised for our $35.17 investment $224,042.80. Now again, that's not a bad return on $35.17, and to make it required just 4 decisions over a 41-year period. Simple, right? But how simple was it? Let's start by looking at gold in the 1970s. Now, gold in the 70s had several big corrections. As you can see, as we go through here, there's a 21% correction, a 17% correction, and then this 18-month-long 43% slide that forced a lot of people to throw the towel in on the trade. But, and this is the key point, the inflationary fears that were the main driving force behind the buying of gold at that time was still very much alive, until the very end of that decade, when it became apparent that runaway inflation absolutely had to be dealt with. Funnily enough, once that did become apparent to the majority of people, we saw a flood of latecomers come into the gold trade and drive the price up by about 70% in the last 8 months of 1979 alone. The change in circumstances surrounding the gold bull case, and by that I mean the soaring inflation and the willingness of the Volcker Fed to actually deal with it, took away the main rationale for owning gold. And that's what meant it was time to look for a new idea. Now, Japan at that time was clearly the next big thing. Japanese equities were extremely cheap at the start of the 1980s, but it was pretty clear they weren't going to stay that way for too long. The Ministry of Trade and Industry in Japan cleared the regulatory decks, and the Japanese companies did the rest. Now, the 1980s saw the Nikkei rise from 5,000 to just shy of 40,000, and it was, for the most part, a nice smooth ride, as you can see here. Having said that, it still offered 3 major opportunities for investors to get shaken out, through either fear or by trying to trade the top of the market and sell their positions at levels they wouldn't see again for many, many years. By the time the Nikkei closed 1989 at its all-time high, and incidentally, I was actually in Tokyo that day, standing on my desk like an idiot, cheering and shouting along with everybody else. Holding Japanese shares for the entire decade had returned almost 8 times the initial investment. But things were clearly changing. The yen's strength was starting to hurt the exporters. Japan's real estate bubble had reached epic proportions. I mean, the kind of numbers that dwarf that which we've seen in the States in the last few years. In fact, in 1989, the story went that the value of the land beneath the Emperor's Palace in central Tokyo was said to be worth more than that of the entire state of California. Banking sector balance sheets were loaded with non-performing loans, and the political landscape had become a complete mess. Sounds familiar, right? Again, the reasons for owning Japan had fundamentally changed. Fortunately, another better opportunity was presenting itself right on time, and that was the NASDAQ. Now, owning the NASDAQ through the 90s was, as I said earlier, the ride of a lifetime. And through that decade, we saw no fewer than 8 corrections of 10% or more, which shook out a lot of holders and even more latecomers before the final surge, when the NASDAQ added 48% in the last 4 months of 1999. By the end of 1999, though, valuations on technology stocks had become so ridiculously stretched that realistically there was only potential downside for anyone brave or foolish enough to pick now as the time to buy them. Although, as Mark Faber actually pointed out quite correctly, the last 6 months of the NASDAQ bull market saw the index double, but at no time during that period was it actually, on anyone's metrics, a fundamental buy. You really were rolling the dice when you bought that. Companies with no actual business trading on 50 to 100 times earnings were commonplace. Huge multiples were being paid for eyeballs. Remember those? Once again, things had changed materially, and the fundamentals that looked so good 10 years prior had completely vanished. But if you'd managed to hold on to your investment for those 10 years, it was obvious the time had come to get out of NASDAQ. And what do you know, we ended up right back where we started. Gold in the last decade has been just about as polarizing an investment as I can recall in my 30-odd years in finance. I wasn't around in markets in the 1970s, but with no internet back then and no 24-hour news cycle, no one's ever going to convince me that the drums were beating louder back then than they are now. From the high $200 levels 11 years ago to almost 2,000, the debate has continued over whether gold is in a bull market, which seems hard to believe that that's still the case after 11 straight years of positive returns, but that's gold for you. And during that time, loose hands have been shaken out hard and often, with each downturn in the gold price being called the end of the bubble by about 90% of market commentators, and precisely 100% of those who don't actually own any gold. The steady build-up of debt in the world, the easy monetary policy, the US housing bubble, and since 2008 anyway, the utter failure of politicians and central bankers to deal with the fundamental problems that lay behind the global financial crisis have all conspired to drive gold higher. Not only that, but as it's gone higher, the amount of manipulation has increased. Now, I completely understand that when I talk about manipulation and gold in the same breath, I know many people tend to switch off. But if you don't believe there's active manipulation of the gold price, that's okay. What's impossible to deny, though, is that there is manipulation of government data. Substitution, hedonics, seasonal adjustments, the birth-death model, they're just a few of my particular favourites. And on the basis that gold reacts directly to that data, whether overt or not, the gold market is manipulated. Now, as you can see on this chart, there have been 6 major corrections in gold over the last decade or so. But with the benefit of hindsight, they were all, well, apart from 2008, they were all short-lived. And anyone selling into those falls, looking to buy their gold back cheaper, would have to be extremely nimble or find themselves on the sideline as gold just kept climbing higher. The difference between this decade and the 3 that preceded it, though, is that this time the basic case for owning gold that we made back in 2000 has not only not gone away, but it has, in my humble opinion, become even stronger. Now, in his famous helicopter speech of November 2002, which he cleverly entitled Deflation Making Sure It Doesn't Happen Here, Ben Bernanke laid out the roadmap for central bank policy that's being followed today. And if we take a close look at his speech, we find all the clues we need as to what we might be looking for when assessing whether the main reason to own gold is about to change. There's that word, always. Now, Bernanke's somewhat simplistic logic is characteristic of economists and central bankers in general, and their absolute conviction that a certain outcome can be prevented with the application of a specific set of measures. That means one thing to us as investors. They can absolutely be relied upon to continue to apply those measures with increasing force if necessary until the outcome they feel is absolutely certain materialises. Or not. Currently, despite aggressive stimulus and a huge expansion in the Fed balance sheet that we've seen since 2008, inflation, or at least according to the government's measurement of it, has failed to materialise in any meaningful way, with the CPI sitting between 2 and 3%. Now, behind me, you can see the most quoted section of this famous speech appearing. Bernanke was telling the world that under his watch, every stop would be pulled out to ensure that deflation didn't take hold. This is a famous printing press part of the speech. And in central bankers' eyes, the only cure for deflation is to generate massive inflation. That's got to be good for gold.